Sometimes a single day in the markets can crystallize a much bigger story, and that's exactly what happened on Monday. When Nvidia dropped more than Ireland's entire GDP in a single session, it highlighted something that my guest today, James Cooper, has been talking about for a while: the growing divide between the overvalued US tech sector and undervalued commodities. Now, what caught my attention was the chart that James, you showcased today, showing how commodities are now the cheapest that they've been relative to US stocks since the early 1970s. Now, when you pair that with the shifting dynamics between the US and China, you describe that we might be looking at a major inflection point for investors. So first of all, how are you doing, James?
Good, thanks, Woody. Good to be back.
Good,
Cheers.
good. So let's start with Monday's market shock. How do you see this AI competition between China and the US playing into the broader commodity story that you've been following?
Yeah, so obviously I'm not a tech expert. My focus is commodities, but I think it's a really important point in the market, especially when you consider the valuation of these US tech stocks and this market concentration. So when you have a big move in what is America's largest company in Nvidia, 17% is a massive move. So then what are the implications, and specifically for us for commodities? And I think if you're an investor and you're perhaps leveraged to these large US stocks, tech stocks, I think Monday would have been a really nervous time. And I think the realization of this concentration of investment in this one particular area is really sort of hitting home. So I think this is sort of the moment, or these types of moments, which should bring the attention back to commodities, back to value. And I think this chart that we spoke about with commodities, the most undervalued relative to US equities since the early 1970s. And some analysts have actually put that back to 100 years, so the value that's on offer. But the early 1970s, that preceded some big events in commodities. The oil crisis, uranium prices spiked through the 70s. So they're all kind of conditions that we've sort of starting to lean towards in today's market. And I think with this transition, there was another chart I showed in today's Fat Tail, just showing that the ratio between the NASDAQ to commodities, it was the Bloomberg Commodity Spot Index. And this ratio has actually hit the same point as it was at the peak of the dot-com bubble. So a sort of an unnerving sign in the markets, especially if you're holding on to these big tech stocks. So I think it's this key moment on Monday that just really emphasizes perhaps why you should be focusing on value, and that's for safety, but it's also for opportunity. Really, if these tech stocks don't crash, how much upside is really left in them for the next 12 months when you compare them to commodities, which are especially junior mining stocks, which are still sitting at cyclical lows. So I think it really does boil down to value.
Yeah, and it's always in bull markets and bear markets, it's always surprising how far they can actually go to, right? So maybe there is a bit further to go. But yeah, those charts showing the NASDAQ to the commodities ratio are striking. And that was actually my next question. I was wondering if you could just elaborate on the historical precedents for this kind of valuation gap and what typically happens when these extremes correct.
Yeah, so there's a few moments in history. We talked about the 1970s and the oil embargoes, which was basically in the Middle East restricting oil exports to the US, and this just caused a huge spike in oil prices. There was also other events that have where we've seen deep value in the commodities market. So the tech bubble. This was sort of the beginning of the enormous shift.
Resources boom, right?
Yeah, that's right. So when the tech bubble burst in the early 2000s, this was really the beginning of a transition, so into the commodities market with the emergence of China, which also lack of supply back in the late 90s sort of played into that as well. So catch up in investment, similar conditions to what we have today. There was the Gulf War, another oil crisis. So different events. Even if you go back to World War One, World War Two, these events sort of caused a spike in copper prices, base metal prices. So commodities are very cyclical.
Yeah.
I don't know if the correlation is inverse to tech. Obviously, the bubble which burst in the early 2000s preceded a huge commodities boom, which followed in the years after, which is certainly a possibility this time around again when you look at the deep valuation gap between those two sectors. So it's really interesting drawing on those parallels, and I think again, if you're an investor thinking of the long term, I think you really should be looking at safety, but also where the biggest gains could potentially come from. I think that's commodities.
Yeah. Fascinating. You made an interesting connection also between China's rising technological capabilities and commodity demand, which is obviously the other side of the equation when it comes to the commodity cycle. How do you see that playing out across different commodity sectors?
Yeah, well, that's another thing we touched on in this piece. Is just another sign of, I guess, the US hegemony. So this US dominance that we're all sort of used to across tech,
Yeah.
across a lot of industries. It's and what the Monday's sort of market action with DeepSeek showed was that America is perhaps not as dominating in the AI, artificial intelligence, as the market believed. So it's just another sign that this sort of breakdown in American hegemony. So now it's lost a lot of manufacturing, so high-end manufacturing, which is dominated by China. And now it's also perhaps losing the race to AI as well. China also has a dominance in critical mineral supply, and then there's
Yeah.
the health system in China is perhaps much better than it is in America. So it really sort of, you got to ask what does the US economy have? It's steeply valued at these levels, whereas China's real estate market, its equity valuations are sitting at cyclical lows. So again, it's looking at value in the market, and I think
Yeah.
we'll see more capital move into where the future growth will be, and I think that's really in China as sort of the center middle kingdom, but then also sort of expanding its manufacturing to places like Indonesia and Thailand.
Yeah.
And I think Australia is really in an excellent position to benefit from this sort of growth, which and capital, which is more likely to flow sort of east. And I think Australia will benefit from that.
The big thing, one of the things that Trump is raging on about, and it's kind of been reported quite heavily in the mainstream too, is that with his, although the China showed itself with the deep seek thing on Monday and how it's advancing in AI, but he reckons obviously his policy is going to bring it all back to the US, and it's actually the start of a great resurgence in the US. But your piece actually says the opposite, really. It sort of touches on how Trump's policies might actually, rather than do that, accelerate China's extension. So how should Australian investors think about that, and how should they think about positioning themselves for that potential shift in global economic power? Or is it like you say, just super simple, buy resource stocks?
Yeah, well, there's different angles. So I think leading into Trump and what's happened to commodities. So commodities initially fell on the back of Trump's re-election, and the US dollar started to rise because investors believed that Trump's tariffs would strengthen the US economy, would bring manufacturing back home. But I guess the other side to that story is the fact that tariffs could actually isolate the US economy and sort of push ahead China's ascension for the rest of the world in global trade. So I think that's one of the outcomes that I don't think is really being considered. And I think that's potentially what tariffs in America could really result in, especially if you've looked at where China is establishing a lot of global trade relations with Asia, with the Middle East. And I think this is sort of like a springboard to help it expand on that. So I think if you're thinking about growth in Asia, I think commodities are always going to be in strong demand. I think maybe perhaps iron ore will do okay from that. I think we could potentially see a bounce back from the lows of 2024. But perhaps maybe specifically more conductive metals like copper, silver, these metals, as these economies become more sort of consumption based and technology demand increases, I think these types of metals could do well. And then, of course, AI isn't going to stop just because China is maybe leading in that race. I think the energy demands will still be there from AI. So whether that's uranium, oil and gas, I think is still going to do well over the long term. So whichever way you square it, I think it's still a very positive outlook for commodities.
Yep. And if we are at the start of what we were back, when the tech bubble burst back in the early 2000s, I mean, there's a whole long decade of re-rating ahead of us. So we'll keep exploring these ideas, and obviously in your new mining memo e-letter, James, you'll be sort of reporting on more of the specific news stories that are happening in this space more often during the week. So yeah, keep on that, and I'll keep following it, and I'll ask you some more questions next week. Thanks, James.
No problems. Thanks, Woody.
If you want to read James's piece below, just check out the links in the comments. It's in the description, and please do leave some comments. Thank you.